Hey everyone, so my name is Zach Vines, and what we're going to look at today are adjusting journal entries and a few different quintessential examples of what you might encounter as adjusting journal entries. So just in general, you have to understand that some accounts have to be adjusted by fiscal year end. So at this point, we're probably used to specific transactions occurring, like something very particular happening that causes a transaction, causes a journal entry to occur. These adjusting journal entries, however, not for every single one, but generally speaking, oftentimes involves something that just happens because of the passage of time. It wasn't something really new that happened necessarily. It's not like a new transaction took place or we purchased something or someone paid us something. It's just because time goes by, we have to make certain adjustments. And especially if we have a transaction that initiates and then we have a year end that happens while that time series is going on, as of year end, we have to adjust everything to that point in time. So we have to very much so understand the timing involved. So we could adjust for a few different reasons, and we'll go through a few examples of each of these reasons in just a moment. But we might want to account for supplies, record interest expenses, because whenever you borrow something or you have interest involved, interest just accrues over time. It's not necessarily something new that's happening as time goes by, like us, again, buying something new or selling something new. It just goes on because of the passage of time. So we have to adjust for interest expenses. We have to adjust for things that we prepay and us using up the benefit of those services. And there are many other examples of some adjusting journal entries that we're not going to get to in this video. But let's go ahead and go through a couple of examples going through accounting for supplies to start with. Okay, so for this first example, what we're doing is accounting for supplies. So what's unique about supplies is that when we purchase them, we don't actually record an expense at the outset. Because the thing is, in accrual accounting, we don't recognize an expense until we've recognized the benefit of that service or that product or whatever it is that we're purchasing, until we recognize the benefit from it. So really when we purchase supplies, because we don't recognize the benefit of it until we've used those supplies up, at the beginning, all we do is increase our supplies account by the amount of supplies that we purchased, and assuming we paid for it with cash, it might be a payable and everything like that, but if it's just cash, you're going to increase your supplies account and decrease your cash account. But the thing is, we need to recognize that supplies expense at some point in time. So we're going to do that at year end. And we're not going to keep up with exactly how much, like the dollar value of the supplies we used up as the year goes by. Like imagine if you went and grabbed paper towels to use, which would probably be considered supplies, and you used up, however many cents of paper towels, and you go and book an entry for that. Instead of doing that, let's just track it like this. So let's look at this example. We start with $300 in supplies. So we roll over from the previous year, we have $300 already sitting in our supplies account. We purchase $200 more of supplies on March 30th, and then by the end of the year, we have $100 worth of supplies. So really the question right here is how much did we use up? Because the amount that we used up is the adjustment you make and what you're going to record as your supplies expense. So we began the year with the $300, then we purchased $200 of supplies. So that puts us at $500 for right now. Then we didn't keep track individually of how much of the supplies we used up as the year went by, but I should know that if I end the year with only $100 worth of supplies, then kind of backing into the amount that was used will be the adjustment. So you can see if I began with $300, I added $200, I subtracted something like whatever amount that I used up that I'm trying to find, and that equaled $100. If you just simply do the algebra, you start off at $500, 500 minus what equals $100, it's going to be $400 right there. So that is the amount of your adjustment. You're going to debit or increase the balance in your supplies expense account by that $400, and then decrease or credit the balance in your supplies account by $400 as well. So that should take care of the supplies adjustment. So let's get into the next example right now. Okay, so for this example, you can see that we're actually borrowing money, and there's interest tied to that borrowing. So you can see right here, we borrowed $12,000 with a 12-month note payable at 5% interest on August 1st, 2019. So we have to recognize the interest expense for 2019. So really when you look at it, we borrowed it on August 1st, 2019, and it's a 12-month note, meaning that from August 1st, 2019 through August 1st, 2020, we're going to accrue interest over that period of time. Well, one good rule of thumb to always remember is that whatever percent interest they give you on the note is going to be for an annual period, okay? But recognize that for 2019, we're not doing, it's the 5% interest, but it's not going to be for all 12 months, only for a few of those months, but we need to go ahead and recognize what that interest expense is for those few months that happened in 2019 because that interest has occurred over time. And as of the end of 2019, you want to accurately portray your financial position, take into account that expense that's incurred. So let's do that right now. So we have a $12,000 note, so we have $12,000 right there, and it's at 5% interest. So I multiply it by 0.05 or 5%, and that gives me $600 worth of interest, but that's for 12 months because that 5% interest right there is an annual rate. So $600 is how much I'm going to pay in interest by the time the note is done. Like over 12 months, that is the total amount of interest that's accumulated, is that $600 right there. But we didn't have 12 months in 2019 because we're really only going from the beginning of August through the end of December. So let's go ahead and take that annual interest and break it down into monthly terms. So if we take $600 for 12 months, divide by 12 months, that gives us $50 a month in interest. Well, at that point, you just have to look and see how many months have gone by in this year so far. Well, if we're at the beginning of August, that would be all of August, September, October, November, and December. Don't be afraid to count on your fingers. I still do it anytime I'm looking at these types of problems. Be very careful for the beginning of the month versus the end of the month. Notice that I counted August because we're starting at the beginning of August. So that entire month does go by. So we have 5 months worth of interest right there at $50 a month. So multiply those two together and you have $250 worth of interest expense for the year 2019. So at that point, you can just debit your interest expense, which increases the balance in that account by that $250, and then credit your interest payable by $250 as well, increasing the balance in that liability account because you're not going to be responsible for paying for that interest until maturity. Sometimes problems may specify that that's not the case. That's a pretty good rule of thumb, though, is that you're not going to owe the principal or the interest until maturity. So we're just going to record payables in the meantime and square away the cash at the very end. So let's get into our final example right now. Okay, so for this final example, what we're doing is accounting for the adjustment during a prepaid service. So let's just read the example. We bought $3,600 of insurance for a 3-year period on 9/30/2019, and we just need to recognize the insurance expense for 2019. So keep in mind, when we first purchased this insurance, we're going to initially record prepaid insurance, and assuming we paid cash for it, decrease our cash account as well. And then as time goes by, we use up that insurance. And so you can see that going from 9/30/2019 to the end of 2019, we don't have 3 years worth of insurance, but rather 3 years minus those couple of months that we used up. So we're just adjusting our prepaid account for those months that we used up. So when you think about it, if we bought $3,600 of insurance for 3 years, when you divide that out on a per year basis, it's going to be $1,200 because $3,600 for 3 years divided by 3 is $1,200 for each year. So because in 2019 we only just had a couple of months worth of insurance, let's break that down onto a monthly basis so we can easily apply it to the number of months that we had in 2019. So $1,200 per year that we just found divided by 12 months breaks us down to $100 a month. So really at this point it's just a matter of counting how many months have gone by in 2019. So how much of that insurance have you actually used, and so what will we record as an expense and an adjustment to our prepaid account. So if we're looking at it, all of September went by. So we're really just considering all of October, November, and December. So 3 months right there. So $100 a month times 3 months is going to be $300. So that's the amount of our adjustment. So we're just going to book the entry by debiting our insurance expense, so increasing the balance in that insurance expense account, and then crediting our prepaid insurance, which is an asset that's lowering the balance in our asset account by that $300. So you can see that adjusting journal entries, it's not as maybe tangible in your mind, and it's not as immediately prompted like a specific transaction that's already occurred, like us buying something new or us taking on this whole new project. It's more of something that happens because of the passage of time, and it's something you have to be very particular to pay attention to because you might not be specifically prompted to do these entries. But when you consider the nature of what's going on behind them, it makes it very clear why you should make those adjusting entries. So I hope this gives you a good framework and a couple of good examples on how you can go about doing those adjusting entries. So thank you so much for watching, and I hope that helped.